This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, we've learnt from a very early stage in our study of capital gains tax originally, and we've repeated it, and now we look at corporate gains and their chargeability to corporate tax. But a chargeable disposal need not necessarily be a sale. For individuals, it could be a gift. Now, companies don't give anything away. But what we haven't as yet seen, either for individuals or until this point in time dealing with companies, what happens where an asset is either damaged or it is lost or indeed destroyed, and then insurance proceeds are received. So that's cash coming in. If cash is coming in relation to a particular asset, here in the form of insurance proceeds, then there's got to be a question mark over, is there going to be a capital gain on that? What's going to be charged here, if anything, as a capital gain? And as we'll see, this is a function of, is there any insurance proceeds to begin with? If there are no insurance proceeds and an asset is destroyed or lost, then it is a disposal, but of course there's no proceeds, so there would be a loss equivalent to the allowable cost. But what happens then if there are proceeds? If it's lost or destroyed, it'll be a simple enough calculation in terms of a capital gain or indeed allowable loss that may have arisen. It gets more interesting in terms of the first on the agenda here. What happens if there is an asset that is damaged? If it is damaged, then if we receive insurance proceeds, may do either of two things with those proceeds. We might just think, you know what, the damage isn't that bad. I'll leave it as it is. And therefore, I'll pocket the money and I'll spend that on something else. Or, of course, what you might do with it is, I love that asset and therefore I'll put it back into its original condition. So the money that's come in the form of the proceeds, I'm going to spend that in terms of making sure that this asset is repaired and restored to its original state. So let's have a look at how that impacts in terms of those transactions in relation to, firstly, damaged assets. Right. If an asset is damaged and compensation or insurance money, would usually be insurance money being received here as a result, then this will normally be treated as, well, we are back to, I hope now, very familiar territory, given what we've previously seen in this chapter, a part disposal of the asset. Where there is a part disposal, we know. What are the proceeds? That's the insurance proceeds now, less what is our cost to set against that. We need the cost to go against proceeds to give us gain. And that cost is whatever was the original cost, and then multiplied by. The cost is calculated using the normal part disposal formula, where we multiply that original cost by, again, this ridiculous equation here of A over A plus B, but where A is, of course, our sale proceeds, the value of the part disposal, over the self-same sale proceeds, here it will be the insurance proceeds, plus the value remaining, the market value of the remainder at the time of the part disposal. Now, what that will be is the value of it prior to any restoration of the asset. So, if insurance money is received, then, if the insurance money is not used in restoring the asset, then this will be a normal part disposal. What proceeds have you received, less our allowable cost, which is the original cost of the asset when acquired, multiplied out by these proceeds over proceeds plus the value remaining, what it is now worth in its damaged state, with the market value of the part retained equating to the value of the asset in its damaged condition. If the insurance money is fully used in restoring the asset, then the taxpayer can elect to have the proceeds deducted from the cost of the asset for a future calculation, thereby deferring any gain when the insurance proceeds are received. So in that situation, we are able to defer the gain. It's a classic bit of rolling over of the gain in that situation where we do reinvest the proceeds. That clearly has an impact now. A gain that would have arisen based on your part disposal calculation is not now going to arise. It will be deferred here. And that deferral will, of course, impact on what cost may be used on a future disposal of that particular asset. We've got a couple of examples to illustrate here. Now, in the first situation, we said here, if the insurance money is not used in restoring the asset, a normal part disposal arises with, as we've said, the market value of the remaining part there, that being the market value of the asset in its damaged state. So example 4 now illustrates that. What are we told? This company bought a painting on the 1st of April 2000 for £10,000. The painting was damaged on the 1st of May 21 when it was worth £50,000. But after the damage, it was only worth £25,000. On the 1st of July 2021, insurance proceeds of £30,000 were received. Now, this is where the chargeable disposal occurs, not when the damage was done, when the proceeds were received. So we've got insurance proceeds of £30,000 being received, and that was on the 1st of July 2021. Like with all of these corporate disposals, you would then need to see into which accounting period does that particular disposal take place, and it would be allocated to that period's corporate tax computation. So insurance proceeds of £30,000 were received, but were not used to restore the painting. Again, we had better things to do with the £30,000 of proceeds rather than simply restore the painting, it would appear. Assume an indexation factor from April 2002, well, we know it would only go to December 17, was 0.549 there. We've got to calculate the chargeable gain arising on the receipt of the insurance proceeds. So what are those insurance proceeds? £30,000. We've taken the money out. The rule, as it says up here, if the insurance money is not used in restoring the asset, it is a normal part disposal, and we know what the value remaining will be, the value of the asset in its damaged state. So that means we've got proceeds of £30,000, from which we will deduct our allowable cost. Our allowable cost, of course, originally £10,000, but what will be the allowable part of that total original cost? Sales proceeds 30 over sales proceeds 30 plus value remaining. Now we have all of those numbers. We know what the value of the asset is in its damaged state there. So that should allow you, yes, I mean you, to do a calculation here of what that unindexed gain would be. Once you have your allowable cost, of course, in that calculation of the unindexed gain, we know what our indexation factor is. You apply that to the allowable cost, and that will bring you down to your chargeable gain figure. So I'd like you to have a go at that now, and then we'll look through the answer together. Okay, let's see how we fared, and hopefully you're looking at the same numbers as we have here on the screen that you have produced for yourself. Here we've pocketed the insurance proceeds. It is a part disposal, end of story. No other options available to us. There's our insurance proceeds of £30,000 going in as our disposal consideration. We need to deduct from that our allowable cost. Well, the original acquisition cost was £10,000. Part disposal, what do? Part disposal calculation, we know it well by now. Proceeds over proceeds plus value remaining. What was the value of the asset in its damaged state? Put it through your calculator, and all being well, that comes to £5,455. Take it away to give you your unindexed gain. We will then pick up that cost figure to go into our indexation allowance calculation. We know, as we'll always be given, the relevant indexation factor, never, of course, after December 17, only to December 17 as the latest possible date. multiply it out, get your indexation allowance, and you've got the chargeable gain that now arises. What may be of interest to you in terms of what an exam question might also ask is you still have a painting, albeit worth less than it was before, as it is in a damaged state. But that too in the future could be sold. So what happens there? Well, as ever, you'll know what the sales proceeds are. The question then is, what will the cost be? Well, we have the answer here in front of us. The original cost of the painting was £10,000. This is a part disposal, and on this part disposal, we have expended £5,455 worth of that cost. So on a future disposal of the painting, what had been £10,000 of cost will be reduced by £5,455 there to give you, what's that going to be, 4,545, I think, but check it out. That will be your allowable cost should you, in the future, dispose of that painting there. We've used up that £5,455 at this point in your part disposal calculation. The remainder, well, that stays in there as the allowable cost for the painting. Let's go back to our notes now. Now, the first situation we've just looked at is the simple one. You just pocket the insurance proceeds. But what about here now? If the insurance money, as we have already discussed through, is fully used in restoring the asset, then the taxpayer can elect to have the proceeds deducted from the cost of the asset. Again, classic rollover. Rather than being taxed now on a gain using a part disposal calculation, what we're able to do is to say, right, the insurance money, I fully used it in restoring the asset, therefore I haven't pocketed any of that cash here. It's gone back into restoring the asset there to its original condition, working condition as the case may be. And on that basis, therefore, we could have a deferral. What does rollover do? It's a classic rollover situation. We reduce, of course, what would be otherwise the base cost. So if the insurance money is fully used in restoring the asset, the taxpayer can elect, so you don't have to do this, it's an election, to have the proceeds deducted from the cost of the asset for a future calculation, thereby deferring any gain when the insurance proceeds are received. So you don't therefore get taxed on a part disposal. Because you've reinvested all of the proceeds, you're allowed to effectively roll this over. How do we do that? By deducting those proceeds from the base cost, and that gives rise to a higher gain in the future. Of course, what we'll also be able to do is, having taken that amount of proceeds from the insurance and having reinvested it all, it may even be that we've spent more than that. The insurance gave us so much, but we've gone further than that. And whatever other restoration costs we have incurred, that would be added in to the allowable cost for a future disposal of this asset. We have, again, as luck would have it, an example that deals with this. Assuming Daisy Limited elects for the proceeds to be rolled over against the cost of the painting, calculate the base cost of the painting on a future disposal. Well, that's what we'll do to begin with anyway. Remember, it's an election. We don't necessarily elect for that to be rolled over. But what's happened? Daisy Limited purchased a painting on the 1st of April 2000. For there again is our cost of £10,000. Obviously, when you see the date of that acquisition being pre-December 2017, you know, as this is a corporate disposal, Daisy Limited here, that indexation allowance will apply. There will be an indexation factor provided through to December 17. The painting was damaged on the 1st of May 2021 when it was worth £50,000. After the damage, it was worth £40,000. What happens? On the 1st of July 21, insurance proceeds of £8,000 were received. All of the insurance proceeds were used to restore the painting. Right, what therefore is going to happen? Well, if we elect for the proceeds to be rolled over against the cost of the painting, it means there will be no immediate gain arising. As they've been fully reinvested, there will be a deferral that arises. How does that impact in terms of the revised base cost of the painting? Let's just again quickly go through to the answers, because there's not much in the way of computations to deal with here. When the insurance proceeds are received, there is no chargeable gain that is going to arise here, as the company has elected to roll over the proceeds against the cost of the painting. So in which case, what was our original cost, we then take out our insurance proceeds to give us, at the moment, a revised base cost of the painting. But what will also happen, of course, the restoration costs themselves of, well, I'm saying here 8,000, can be deducted on a future disposal. They've got to be at least 8,000. We have to reinvest all of those insurance proceeds. But it may be more than that. Here, if it was exactly the £8,000 of proceeds received that was then used in the restoration, and the restoration costs were £8,000, then that's fine. All you'd have here is taking away from the original cost the insurance proceeds, giving you a revised figure of 2,000. You then add the 8,000, so plus 8,000, and that would be back to £10,000 as the base cost. If the restoration costs had been £10,000 there, you'd only got insurance proceeds of 8. You've spent 10 to get this into extremely good working condition. Then, of course, you still have your 2,000 here, but now it'd be plus 10,000. Whatever those restoration costs were, whatever you've actually incurred there, that would be added on, and you'd have a, what would that equal there? £12,000 as your allowable cost on the future disposal. Now, what we've said, of course, is that, fine, the ability to roll over exists there. If you reinvest all the proceeds, then you're able to defer any gain arising on what would otherwise be a part disposal calculation now. We can avoid that. What does it do? Well, rollover isn't an exemption, it's a deferral, and therefore it reduces what would otherwise have been your original base cost of that asset. With any restoration costs that you do incur, you must here, of course, have spent it all to have rollover, but when those restoration costs are incurred, those are also going to be included on an eventual disposal of the asset here, a painting, I think it was here, should that be disposed of in the future. And there were the possible cost figures, depending on what those restoration costs were. But of course, that's if you choose to defer. Now, logically, you think that the company would defer again. Why be taxed now when you can be taxed later? But a question might ask you to compute what would be the situation if we did not make, or if we did and we did not make the claim for rollover. What would it be? So in which case, therefore, what we'll now do is to say the damaged asset. If no election to roll over is made, then a part disposal would arise. Now, we've just done the part disposal calculation in example 4. So, following the same logic here, what are the proceeds? The proceeds are £8,000. I would have just checked that we've got that right. Yep, there's insurance proceeds, 8,000. The other figure I'll need, what's the value of the asset, again in its damaged state? After the damage, it was worth 40,000. Because that's going to come into your part disposal calculation. The original cost 10,000 times, as ever, proceeds over proceeds plus value remaining. Now again, I think that's 8 over 48 is what 1/6 of 10,000 is about 1,666, 667, whatever you want to make it to be. Take it away, and that's a chargeable gain, therefore, of £6,334. If you choose to be taxed on that, you don't choose to defer the gain, then what we have, of course, is that we've got a base cost now of the restored asset, that would be 10,000, the original cost, minus the amount of that cost we have used here on this part disposal calculation, plus whatever we incurred on restoration costs. That had to be, again, it could be 8,000, it could be more than that, whatever. And that means we'd be looking at a base cost that's going to be £6,334 bigger than it would otherwise have been with the election in force. That, of course, being this gain having now not been deferred. It does not serve to reduce the base cost as would otherwise have been the case. So what we end up with is 16,334 instead of £10,000 as our base cost. That means that we get taxed now on that £6,334 rather than later, because the cost in the future is going to be 16,334 rather than £10,000. And we might say, well, if you've got a choice here as a company between being taxed now on a gain or in the future on a gain, well, when do I want to be taxed? Well, I want to be taxed in the future rather than that. It would seem logical to do that. If it was an individual that you were dealing with, remember, we're looking at these rules now in the context of corporate tax for capital gains. We're dealing with companies. Companies do not get an AEA. Companies get indexation allowance, as we've just seen, in computing any gain, should it be available, i.e. the cost was pre-December 17. But they don't get an AEA. An individual does get an AEA. So if this had been an individual, who was it, Daisy, was it Daisy Limited? Yeah, so had it been Daisy instead of Daisy Limited that we were dealing with, then if the only gain that Daisy made in the tax year was £6,334, or there were some other gains of just a few £1,000s, but when combined together with the 6,334, did not exceed the AEA, currently for the 2021 tax year, as we know, some £12,300. So you could have nearly £6,000 of other gains on top of this. Then there would be no point in deferring a gain if effectively it could be exempted now. If your AEA will cover that gain, that means that £6,334 of gain is exempted now, rather than being taxed later. So for the individual, the last thing you want to do is to make that claim to roll over, because all you do is you waste your AEA of this year and you end up paying tax on a bigger gain in the future. Let's be charged now in our capital gains tax computation. Let's just be charged on that gain now, because when we deduct the AEA, we'll end up with no taxable gain. So it's exempted now, and that therefore has got to be simply better than deferring it from now to the future. So with individuals, we don't mind at all if for the entire tax year our gains fall within the level of the AEA. The last thing I'm going to do is to defer something, so to be charged on it in the future, if I could be exempted on it now. Exemption now is a whole lot better than deferral to the future. So far as a company is concerned, why would a company do it? Well, again, all you know about corporate tax rates is that they have been 19% for the last 3 financial years there. That would mean that if I'm going to be taxed now at 19%, or in the future at 19%, this is easy, I'll defer. I will be taxed, I will roll over, I'll be taxed in the future at 19%. Why pay that same amount of tax sooner if I could defer it until a later point in time? Obviously you would do that. If, of course, as is now going to happen, it would appear within the UK, none of which you need to be aware of, by the way, for your exam. But given the costs of dealing with the pandemic, we are talking about huge amounts, of course, of money having been borrowed, and that's got to be paid back. Who's going to have to pay it back? Yeah, the taxpayers. And companies, then again, depending on their size, but many companies will be paying tax at a very much higher rate in a few years' time. So if you've got the possibility of, say, paying tax in a few years' time on the disposal at 25% rather than 19% now, then you know what? I'll go with now. I'll pay less tax now rather than a lot more tax later. But again, if it was dealing with an individual, and that's the issue you've got to look at, then of course it could be part of a planning issue here, whereby it might be better not to go down the rollover, the deferral route, but to decide to be charged now, because you won't pay any tax on that charge now, because you as an individual, unlike a company, get AEA, and that means it can be exempted now, and that's better than deferring to the future. Okay, back to our notes. There's just one other situation to deal with, which actually is easier, and that's if we have the destruction of an asset, or an asset is simply lost. Now again, if an asset is destroyed or lost, and there is no compensation or insurance money, no insurance proceeds, if there's nothing received, there is a disposal, but that will result in a capital loss. You've got the disposal consideration at zero, take away your allowable costs, that therefore will give you an allowable loss. Remember, a company, indexation allowance would not then apply. You cannot use indexation to increase or create a loss. If there is compensation, or again it's likely to be insurance proceeds that are received, this will normally be brought into an ordinary gains computation as proceeds. The date of disposal, as we know, is the date the insurance money is received. If the insurance money is used to buy a replacement asset within 12 months, the gain can be deferred until the new asset is sold. Again, a piece of classic rollover here. If only part of the insurance money is used to buy a replacement asset, then some of the gain will be taxed immediately and some of the gain will be deferred. Let's have a little look, therefore, at how to apply these rules in relation to example 6. Again, you reading an objective testing question in the exam, you do not know who you are dealing with, so that's the first thing that you'd have noted. It's a company, so this is a corporate gains problem. There's our cost, £23,000 in June 2013. Destroyed in October 2021, insurance proceeds of £34,000 were received in March 2022. So there's the date of the transaction in terms of the chargeable disposal. And again, for a company, you look at what accounting period that arose in. For an individual, what tax year did that arise in? SC Limited spent £30,000 on a replacement asset in June 2022. So we have received insurance proceeds of £34,000, and we've got £30,000 of that being spent on a replacement asset in June 2022 there. So what I'd like you to do, first of all, is to just deal with the disposal. There is a disposal that has occurred where we know our insurance proceeds, £34,000. We know what the cost of the asset was. We know when we incurred that cost. And of course, we're also given indexation factors. It won't be too tricky there to choose which indexation factor to use to establish the chargeable gain that arose. We'll then consider the possibility of deferral, of rollover. And at that point, we'll have to consider the fact that we received proceeds of 34, but then we spent only 30. But let's just do the basic calculation of the gain on the disposal without yet worrying about what happens about the reinvestment that does take place in terms of a replacement asset. Okay, so if you can work out that gain first of all, please, and then we'll take it from there. Okay, let's see what we have here, therefore. Well, again, it's a simple disposal that you're dealing with. Remember, this is not a part disposal. This is the destruction, the loss of an asset. It's gone. It's not just a bit of it that's gone. It has gone entirely. It's an outright disposal. So there's your proceeds. There's all of the original cost to bring you to your unindexed gain. Pick up the relevant indexation factor, which we know very well by now. It's that taken from the date of acquisition through to December 17 at the latest. That gives us, it would appear, £5,750 worth of indexation allowance, and therefore reduces the chargeable gain to £5,250. And if we do not do anything else, there is your gain, £5,250. The gain rolled over. Now then, this is where there is the issue of, well, had we reinvested all of the proceeds there from the insurance, the full £34,000, then we would have been able to defer all of this gain if we chose so to do. Again, if we're dealing with an individual, you may not necessarily defer a gain if at this point, if you left it chargeable, it still wouldn't be taxable because it is within your level of AEA. You would choose, therefore, not to defer. You would crystallise the gain because you won't be taxed on it because it's taken out by the AEA. But here, what have we got? We've got insurance proceeds of $34,000, of which we've reinvested only $30,000. So proceeds have only been partially used to rebuy a replacement asset. Therefore, that difference of £4,000 of the gain is chargeable immediately. So in which case, like we do with rollover, we work out in a partial rollover situation what the amount of gain chargeable will be, and if that, as it is here, is less than the chargeable gain that has arisen, then the rollover is simply a balancing figure, the difference between those two figures here. So we have reinvested sufficient at 30 compared to the proceeds of 34 to get some rollover. Again, the revised chargeable gain is £4,000. That's the figure you calculate. 4,000 is less than 5,250. Therefore, what's the difference? And there is your rollover. What do we do with rollover? We reduce the base cost of the replacement asset. It had cost $30,000. The rollover is $1,250. That therefore rolled over against the replacement asset's cost, bringing it down to a revised and of course lower base cost of $28,750. Should it therefore be disposed of in the future, then that will be the cost to use. We've been speaking there about rollover, haven't we? Which is rather neat because where we go next, in terms of our next and final chapter indeed, in terms of dealing with corporate gains, is the area of reliefs. That was a huge chapter for individuals, chapter 14. I'm sure it scars your memory at this point. But so far as corporate gains are concerned, it's very much quicker and easier. Because as we said at the time, and indeed at the very beginning of our study of corporate gains, one of the differences that existed here that makes life easier for us is that there is only one relief, and that indeed is rollover relief that we need to be aware of. So what I'd suggest that you do, we've done like a little bit of rollover relief practice there, but go back to chapter 14, look at your rollover relief issues. There we were dealing with an unincorporated trader disposing of a qualifying business asset and then reinvesting either all or at least some of the proceeds in terms of another qualifying business asset, and the reinvestment taking place within the relevant timescale permitted. And if that happened, then we'd have the deferral. How did the deferral work? just as you've seen there. The base cost of, well, here it was a replacement asset. In terms of rollover relief in general, it doesn't have to be a replacement asset, it just has to be a qualifying business asset there. And if you do that, then you're able to roll over the gain that's now arisen against the base cost of the new asset. If, of course, you fail to reinvest all of the proceeds from that sale, then that amount of the gain is going to remain chargeable, as you've seen here, and only the balance will be eligible for rollover. The only thing that is different in terms of what you see in the notes, but I'll take you through those in our next lecture, and indeed then that is our next chapter. The only thing that's different, of course, is in computing a gain to be rolled over, or to go into a rollover calculation anyway, we're going to deduct indexation allowance. But other than that, the techniques, the rules are exactly the same. So have a quick look back, please, before next time at Chapter 14 at Rollover Relief, and we'll then be able to quickly and easily, more easily anyway, go through that chapter with you next time.